Many beginner traders will get confused when they see option chain with so many expiry dates. Welcome back to BullBear Logic. Today we are going to discuss about option chain with different expiries. And before we jump into the topic, please remember I am not a financial advisor. I am making this content only for educational purposes only. And in our previous videos, we discussed about call side and put side, and just will quickly recap all those four. And call buy means when you are bullish, you will take a call buy contract. For both call buy and put buy, you are going to pay the premium, and your risk is limited whatever you pay for the contract. But when it comes to call sell and put sell are bit different. When you are neutral to bearish, you will go with call sell contract, and when you are bullish to neutral, you will go with put sell contract. And in this both sells, call sell and put sell, you will get the premium, and this is unlimited risk. When call sell in general traders will take means when they have shares like 100 shares, and they are waiting that stock to go higher, or they want to hold that stock like a long term. They in general they prefer to do this call sell to get the passive income. But sometimes they may their shares may get called away, but for that there are options to roll and all. And as well as put sell, where traders want to buy their favorite stocks with the discount prices, they will go with the put sell. And these two will discuss in depth in our later classes. And now quickly we'll see the option contract. Earlier we discussed in our old other classes, we discussed about this ask bid. Ask means it's a buy, bid means it's a sell. But if you see like there are different expiries available here. So what are these expiries? In general, like contract expires like days, within days, those will be bit cheaper. If you see, this is 1 day expiry, and this is only like 1.74, which means $174. If you take 10 days expiry, it will be 5.20, which is $520. If you go like 1 month out around, it will be $10.70. And if you go like 1 year out, it will be even more expensive, like around 36.95. And these other contracts also available, these are even more expensive. Why these are expensive and all, we'll discuss in our later classes. So as you see, now like exactly what is the expiry? Expiration is the last day of the option contract. After that expiry, that contract is worthless, which means there is no value. So either you need to close before the expiry. Sometimes if you don't close, if it is a put sell, they may assign the shares. If it is a call sell, they will call away your shares. And types of expiries, as we see earlier, we see many in that: weekly, monthly, quarterly, and leaps. Leaps means anything above 1 year, in general we'll call leaps. And short expirations, anything which is 0 to 30 DTE, less time for the trade to work, lower premium. We saw earlier, right? If it is 1 day, which is only 1.75, $174. And who will take this zero like short expirations? In general, day traders, scalpers will take like a 0 DTs or anything like, within a week expiry. They will prefer those contracts as they are cheaper. And long expiries, anything like a 30 plus DTE. And swing traders in general will prefer these 30 plus DTEs, like 6 months or weeks or even years. and it's depend on your trading style, which there is no expiry is good or bad. It depends on your trading style. You have to pick your contract. And market volatility, like shorter expiry contracts have a high volatility, longer expiry dates will have a low volatility and time decay, and these short expiries have a very fast time decay. And now we'll see how time decay affects our options. As the expiration approaches, the last 30 days we have the highest time decay, and last 7 days we have fastest time decay. And it's always better not to wait until the expiry. So you have to monitor your trades properly and manage them it wisely. And how to choose expiry, it's depends totally, again depends on your style of trading. For quick traders, scalpers, it's good like 0 to 7 dtes, and medium term, which is like a 7 to 45 days dtes, and these are good for like a swing traders. The premium is bit expensive, but it will give some time your trade to work. And long term, which is anything 45 dte, this is also good for like a swing traders. But if you go anything 1 year out, which are called leaps are good for like to give even more time. In general, investors prefers these leaps. And some important things we have to remember, like if your option is in the money, itm means in the money at expiration, we may get assigned. And always check last trading day, time can vary from like symbol to symbol. And plan your exit before expiration, like don't wait, again I mentioned earlier, don't wait till the expiry date. Time is a cost in options, so use it wisely. And in our next classes, we will discuss about intrinsic value. Uh, in that week, we will discuss intrinsic, extrinsic value, how the option price moves. And if you like this video, please like and share with your friends, and don't forget to subscribe to my channel.